Ever found yourself staring at your student loan statement, wondering how you're going to tackle this financial mountain? It's a common predicament, isn't it? That feeling of anxiety, the confusion that swirls around when it comes to repaying student loans. It's like standing at the foot of a towering peak, unsure of which path to take. The fact is, understanding your student loan repayment is not just about paying off a debt. It's about making informed decisions that can shape your financial future. It's about understanding the strategies, exploring the options, and choosing the best route that suits your unique situation. It's about taking control of your financial destiny, rather than letting it control you. This task may seem daunting, and it's perfectly normal to feel overwhelmed. But remember, every mountain is climbed one step at a time. But don't worry, you're not alone in this. We're here to break it all down. To start, you need to get familiar with your loan. Just like how you wouldn't drive a car without first understanding how the pedals and gears work, navigating the world of student loans requires a similar level of understanding. So let's dive in. First, you need to know the type of student loan you have. Is it a federal loan or a private one? Federal loans are given by the government and often come with benefits and protections that private loans, offered by banks or financial institutions, might not provide. Knowing which kind you have is the first step in crafting a repayment strategy that works for you. Next, let's talk about interest rates. An interest rate is essentially the cost of borrowing money, expressed as a percentage of the loan amount. It's like a ticket price for the privilege of using someone else's money. Whether your rate is fixed or variable can greatly impact your total repayment amount. A fixed rate stays the same over the life of the loan, while a variable rate can change over time. Understanding your interest rate can equip you with the knowledge you need to anticipate how your loan balance will grow over time. Now let's move on to loan terms. This is the period over which you're expected to repay your loan. It could be 10, 20, or even 30 years. The length of your loan term can influence both your monthly payment and the total amount you'll end up paying back. Remember, a shorter term means higher monthly payments, but less interest over time. Conversely, a longer term means lower monthly payments, but more interest in the long run. Understanding your loan, its type, interest rate, and terms is like having a map when you're lost in the wilderness. It can guide your decisions and help you create a repayment strategy that fits your financial situation and goals. With this knowledge, you're ready to explore repayment options. So let's venture forth and discover the paths available to you in the world of student loan repayments. Stay tuned. If you have a federal student loan, there are several strategies you can consider. First up, we have the standard repayment plan. This is a straightforward option where you pay a fixed amount every month for 10 years. It's a good fit if you're seeking simplicity and predictability in your loan payments. Next, we have the graduated repayment plan. This plan starts with lower payments that gradually increase, typically every 2 years, over a 10-year period. It's designed for those who expect their income to rise over time. The extended repayment plan is another option. This plan allows you to make smaller, fixed or graduated payments over a longer period, up to 25 years. It's suitable if you have a high loan balance and need more time to repay it. Then there's the income-driven repayment plan, which includes several subplans. These plans set your monthly payments at an amount that is intended to be affordable based on your income and family size. They're a good choice if your federal student loan debt is high compared to your income and family size. Finally, we have the pay-as-you-earn or PAY plan. This is an income-driven repayment plan where your monthly payments will be 10% of your discretionary income, but never more than you would have paid under the standard repayment plan. The payee plan is ideal if you have a high debt-to-income ratio and a steady income. Each of these plans offers its own unique benefits, but they also come with their own set of considerations. It's crucial to understand how each plan works and how it might impact you over the life of your loan. So there you have it, the 5 major federal student loan repayment plans. As you navigate your repayment journey, remember, it's not about finding the perfect plan. It's about finding the one that best fits your individual financial situation and goals. Remember, the best plan for you depends on your financial situation and goals. Now let's dive into private student loans. Private student loans are a different beast altogether compared to their federal counterparts. One key difference is their flexibility, or should we say, lack thereof. Whereas federal loans come with a suite of repayment plans based on your income, private loans are far less accommodating. So what's the game plan here? The first step, understanding your loan agreement. Think of it as a roadmap to your debt. The terms and conditions outlined in your loan agreement are the rules of the road. They'll tell you everything you need to know about your interest rates, your repayment schedule, and any penalties you might incur. You see, private loans don't have a one-size-fits-all approach. Each private lender sets their own repayment terms. That means you could have a different repayment schedule, different interest rates, and different penalties for late payments for each private loan you take out. It's vital to read and understand each loan agreement before you sign on the dotted line. Now, you might be thinking, that sounds a lot less flexible than federal loans. And you'd be right. But don't despair. There are still strategies you can use to manage your private loans effectively. One such strategy is to prioritize your private loans in your repayment plan. This means focusing on paying off your private loans first, especially if they have higher interest rates than your federal loans. By doing this, you can save yourself a significant amount of money in the long run. Another strategy is to consider refinancing your private loans. This involves taking out a new loan with a lower interest rate to pay off your existing loans. Refinancing can potentially lower your monthly payments and help you pay off your loans faster. Finally, don't be afraid to negotiate with your private lender. Yes, you heard that right. Some lenders might be willing to adjust your repayment terms if you're facing financial hardship. It never hurts to ask. While private loans may offer less flexibility, they can still be managed effectively with the right strategy. You might be thinking, what if I have multiple loans? Well, consolidation and refinancing could be your answer. Let's dive into these two concepts. First, let's talk about loan consolidation. Imagine you have a basket of apples, oranges, and bananas, each with different prices. Now, instead of dealing with each fruit individually, you decide to combine them all into a fruit salad, giving you one price for the whole mix. That's essentially what loan consolidation does. It combines multiple federal student loans into one, giving you a single monthly payment. However, the interest rate of your consolidated loan is the weighted average of your original loans. So, while it simplifies your repayment process, it doesn't necessarily lower your interest rate. On the other hand, we have refinancing. This is like trading your fruit salad for a cheaper one. Refinancing allows you to take out a new loan, often with a lower interest rate, to pay off your existing loans. This could potentially save you a significant amount of money over the life of your loan. But before you jump in, remember that refinancing federal loans with a private lender means you'll lose federal benefits like income-driven repayment options and potential loan forgiveness. So weigh your options carefully. Consolidation or refinancing can be a game changer, but they're not for everyone. No matter the strategy you choose, making payments on time is crucial. Now let's break down why this is so important. Imagine this. You've secured your student loan, you have your repayment strategy all lined up, and you're feeling good about it all. But then, life happens and you miss a payment. Suddenly, you're hit with late fees. These aren't just a one-time nuisance. They can pile up and increase your overall debt. And it doesn't stop there. Missed payments can lead to increased interest rates. This means that over time, you'll end up paying more than you initially borrowed. It's like a snowball effect, and trust me, it's a snowball you don't want to be at the bottom of. And perhaps the most damaging consequence of all is the effect on your credit score. Late or missed payments can cause significant damage to your credit rating, making it harder for you to secure loans or credit in the future. It's like a shadow that follows you around, making everything just a little bit harder. But there's a solution: automatic payments. Setting up automatic payments can help ensure you never miss a payment, keeping those late fees, increased interest rates, and credit score dents at bay. It's a simple step, but it's one that can make a world of difference. Remember, the key to conquering your student loan is consistency and diligence. Making payments on time every time is a crucial part of that. So there you have it. Navigating your student loan repayments need not be a daunting task. Remember, understanding the details of your loan is crucial, and exploring your repayment options, both federal and private, is key. Consider consolidation or refinancing if it makes sense for you, and always strive to make payments on time. These steps can make a world of difference in your financial journey. With patience, diligence, and the right strategy, you can conquer your student loan mountain. You've got this.